I would, let's say, depending on location and activity you're working on, I would definitely use leverage to improve the calculation on it. But given what I said before, depending on what type of investor you are, I would definitely look at residential on the larger scale, not only in Germany, but also at the opportunities emerging possibly in the Dutch market and some other markets. We have a lot of opportunities still in the Danish market or in the Irish market. I would look for offices where you have to do some management activity in Germany, in the regional, in the smaller type of cities, not only in the big seven, but also there, but also in the smaller cities. I would look at possibly some of the second tier cities in Denmark outside Copenhagen. Also look at the UK market. I think resi in the UK is an issue where there is an opportunity possibly out, but you have to be quite aware of that. There is an election looming in 18 months in the UK, and the question is, do you really get a clear picture of what are you able to operate in the UK market? Nevertheless, I would say the UK market, regional cities would be one of the parts to look at, given you have the pledge from the asset management on, and I would put a part of it in retail. These kind of supermarket anchored, food retail anchored assets we've also acquired in Germany in the last month.
Great, thank you. Gary, how do you invest the 500 million?
Yeah, I fully agree with what Marcus said, and I would also put a little leverage on it, 30 to 50% max, so they have a nice portfolio to diversify. I fully understand. I mean, it would diversify across Germany to the big cities, but also including the 7-1. Maybe also one or two assets in the office sector in small interesting cities. For example, make Leipzig as an example in the city center, but also Nuremberg, an interesting city. So in the office, then retail roughly 30%, a little bit shopping center, and also food retail. Logistic is something what we like, where you should add on. So and also residential, the four sectors. And then a combination of, let's say, 30-40% more core plus, and then also you can do a little bit more value add, shorter leases, maybe, and development, and then a combination of all. I think the main thing is that what we advise to our clients is diversification through locations, sectors, regions, and also through the tenants, so that you have a balanced portfolio and can work it out the next years. And have a combination of income stream and also a little bit asset management approach. So it's an income and growth portfolio, and then I think you can sleep well the next coming years.
Okay, good, thank you. Daniel?
I think I would first of all make a regional split among Western Europe between Germany, 85% of the money, which in my legal skills of calculating are correct, is 425 million, and I would invest 75 million in core available products in Spain. Because I believe, even though I look at your high youth unemployment rates in Spain, it is impossible that this will last for a longer period. Now you can draw to conclusion, either Spain breaks up into regional, insignificant and maybe impossible states, which I don't think will be the case, or you will have a turnaround. And I think the relatively, compared to others, low public debt of Spain is a good indication that will be. So this is where the massive gains of my portfolio in 5 years' time will come from. The rest I would invest in Germany. The way I've told you all this morning, I would have almost an not evil hopefully. One never knows.
It's too late, I've already tweeted evil.
An even split among the real estate asset classes in Germany with, I hear your point, but still my gut feeling is a slight under percentage in the large shopping centers. I would definitely not only invest in the big 7 in Germany, but in the roundabout of the 20 cities I was mentioning, maybe with a higher percentage in the 8 or 9 or 12 cities, which are not the big 7, than the big 7, to have a good allocated portfolio, and through my gains in Spain in 5 years' time, I will outperform all of you, but Tito, who will just let us know how he will do that.
How are you going to outperform everybody today?
Yeah, you might still outperform because you're taking more risk. I would put a third into something very safe. It will be residential in central London. It is very expensive already. It's getting even more expensive. It will give you very, very low distribution, but it will give you very safe money and very liquid money. So if you want to get out of that, you can do it within a month or 2 months' time. So that would be the safe part of it. Then the second third would be what we're doing here, German retail warehousing for the distribution, for the cash flow, also on 50% leverage. And then the last equal proportion would go into capital gain plays in Madrid and Milan. The Tiffany building in Madrid that I mentioned last year, this event was finally sold after 10 months for 6.5%. Tiffany as anchor tenant, central Madrid location. And a deal like that in a good market would go below 5%. Deals like this one in Madrid or Milan will always be sustainable. And if not, then it was only a third that I lost. So fine.
Thanks for all of that, and thank you very much to the panel. Thank you.